Just an hour before we went to air this morning, some big news about the state of the country's economy.
There was a 50-50 chance that this is what they were going to do, and they've gone and done it. So our new overnight interest rate is 4.75%.
Yeah, the Bank of Canada has raised the overnight rate by 25 basis points. And that hike brings it up to 4.75%, the highest the key rate has been since 2001. To repeat, 4.75%. Here's one reason it gave in a statement. Overall, excess demand in the economy looks to be more persistent than anticipated. Translation? The economy is doing too well. Now, economists were split over whether the Bank of Canada would make the move, partly because we've been sitting at the same rate since the end of January. There was kind of this thought that maybe that was it. Well, no. Despite the bank's best efforts to cool Canada's economy, things are heating up again. So let's break this down. And if some of what I'm about to say sounds familiar, it's because it is. But there are three key indicators from the past few weeks that have clearly caused concern. Number one is GDP. And it was up in the first quarter of the year, which should be good news, except not when you're trying to fight inflation. The original estimate for the GDP growth this year was supposed to be 2.5%, but that's been up to 3.1%. So that's red flag number one. Number two is inflation, and it is up again. After a pretty steady decrease, it almost felt like we were in the clear there in April, but it inched back up to 4.4%. Not good. And number three, jobs. Jobs growth has been the bane of the bank's existence in fighting inflation. In April alone, Canada added 40,000 jobs, which is a surefire sign of an economy that's just overheated.
Now, there may be a variety of reasons for this, but the fact still remains is that in aggregate, prices continue to rise, the economy continues to expand, and we're not seeing any kind of weakness in the labor market at all.
Those key indicators were enough to raise the rates an extra 25 basis points. This is the 9th rate hike in the past 14 months. So who's impacted? Well, in short, all of us. With interest rates going up, it once again makes it more expensive to borrow money, especially for big purchases and assets. But those with fixed mortgages haven't had their rates change, and they certainly will when they go to renew. Those with variable mortgages, that's a different story. And rising rates are leading to drastic measures, including mortgage defaults. So this is going to hurt.
It's almost like you need more pain to bring the economy under control. I don't know why we need more pain, because their rates are only making things worse for the housing market. And that's where the biggest bite out of everybody's income, whether you're an owner or a renter, rich or poor, comes out of what's happening to housing prices. And that's a direct effect of the Bank of Canada.
With the bank's target rate at 2%, economists say something has to happen.
Our goal was not to stop inflation from rising beyond 4 or 5%. Our goal was to get it back down to 2%. I would estimate that until we start seeing some of those diagnostic numbers turning in the opposite direction, and until we start seeing inflation coming down and staying sustainably within that 1 to 3% band that the Bank of Canada targets, I suspect we're likely to see more rates.
So the big question, will this trigger a recession? And could that be by design? We've been talking about a looming recession for months now, but causing one on purpose? What's that about? We're going to delve into that tomorrow. Join us then. I'm Lauren Bird. Thanks for watching.